Okay, good. Now, I'm going to continue on from the previous balance sheet. Now, I've taken the figures out, okay, but I've rearranged the equation. Now, the previous equation was assets were equal to liabilities plus equity, okay? And what you can see here is that I've got assets minus liabilities are equal to equity. Okay, the reason I've done this is because sometimes when you look at textbooks, this is the form of the original equation that they present you with. Okay, and in fact, in the UK, when you see a balance sheet or a statement of financial position, this is usually the way it is presented. Okay, what will happen is they will want you really to figure out what the net assets are, because the net assets are the actual value of the real assets in the company, the value of the company, and they equal the equity. Okay, so this is actually a very convenient way of presenting the balance sheet. Convenient from the point of view that it tells you how much the real assets in the business are worth. Okay, but it sort of, well, I won't say it cheats, but what it does though is it brings liabilities to the other side of the equation. So you've got, instead of, as I said, instead of having assets are equal to liabilities plus equity, you now have assets minus liabilities are equal to equity. Okay, now that's okay so long as you are just looking for the net asset value. Okay, so let's put in some figures. Now remember, this first company here, business A, was the lowly geared company, which means that there was very little, or in fact, in my example, there was no debt. Okay, so let's say the owner puts 10,000 into the business. Okay, and where did that come from? That came from the owner. And you can see there that the blues are balanced. Okay, now in the other example, the owner put 2,000 into the business. Okay, so assets are going to be 2,000. Where did that come from? That came from equity. So you can see how much the equity is, you can see how much the assets are. Now, then this one will say that they got no assets, or they got no extra assets from external people. There were no liabilities. But this one, there were 8,000 of liabilities. Okay, so that means that your assets are going to go up. Okay, and your liabilities are going to go up. Now, so you can see there that there are 10,000 of assets, and you can see there that there are 10,000 of assets. Here, though, they deduct the liabilities from the assets to give you the net assets, because these are the real assets that are in the business, and this is how much the business is really worth. Okay, so there are assets to the value of 2,000 in this business, and that's how much the owner could take out of the business. Over here, there are assets to the value of 10,000, and that's how much the owner could take out of the business. Okay, so as I say, that is useful, but we need to approach this with a little bit of caution, because we've brought this to the other side of the equation. Now it's become negative. And you can see here that actually I have taken away the debits and credits. Okay. And the reason why I've taken away the debits and credits is because the debits and credits only work if everything is positive. If all the master accounts, assets, liabilities, equity are all positive. If they're all positive, then the equation that I've been showing you all the way along up to this point, assets are equal to liabilities plus equity, works. That's the one that you should be using. Okay. Let's see if I can bring up. Yeah, okay. And there should be a plus sign in there. But you see, that's positive, that's positive, that's positive. So therefore, because all of those are positive, that's how, to make those go up, the debit increases, credit decreases. To make these go up, credit, credit. To decrease these, debit, debit. But as I say, that only works so long as all of them are positive. Okay? once you start making them negative, you can't really do your debits and credits. So it's an important point to note that when you're doing your debits and credits, you're doing them in this form. And mostly because most transactions that you will be doing, you'll be doing debits and credits, right? So this is the form of the equation that you want, and this is the form of what's going on. Okay? But when they present the balance sheet, at that moment when they present the balance sheet, they decide, well, let's bring the liabilities to the other side to get the net assets. Okay, now, that's okay for that moment, okay? But everything up to that point was done with the normal equation with liabilities being positive, because that's the only way the debits and credits will work, okay? Then for the balance sheet, for that, when that published balance sheet, that published statement of financial position, they sneak liabilities over to the other side, which is useful for that point in time. It's useful to owners to know what the value of the company is. But then afterwards, when you go back to doing transactions, you go back to assets are equal to liabilities plus equity. Okay, so as I say, you will see this sometimes in textbooks. It is not wrong. It is used when the balance sheets are drawn up, but it won't help you with your debits and credits. You just do it. You do all the debits and credits up to this point. Then when somebody says, we want the balance sheet and with showing the net asset value, you do this and then take it back and then go back to normal for your debits and credits. Okay. Now, could you do a balance sheet this way around? You could. I've seen one or two. Okay. You could do it this way as well. All right. Okay. So that's it. I think that's an important thing to realize when you are doing accountancy. Okay.